Welcome back to All Things Money. My name is David Blain, and on today's show we're starting our annual 2011 forecast. Every year at this time we try to give you an idea of what to look for in the year ahead in terms of the stock market, bond market, commodities, and the economy. And during the first couple of segments, we gave a broad overview and then moved into the stock market. If you happen to miss the first couple of segments, feel free to visit us on the web, www.dlblain.com. There you'll find archived copies of the show. You can also email us at allthingsmoney@dlblain.com. We'll probably have a newsletter out on this in the near future we could send to you, or give us a call at 252-633-0107. So we're going to try to finish up with our detailed outlook of the stock market. The biggest threat we see to the market globally is rising interest rates. As I mentioned before, some rise in the interest rate level is good, but if interest rates start to rise too fast, that's negative for the stock market. In fact, interest rates in China and Brazil have already started to get very high. They're very concerned about inflation, and so we have to watch that trend. You know, in the U.S., we're a little bit behind it. People are still a little bit worried about the recovery, and anybody out there that gets a Social Security check knows the past 2 years there have been no inflation increase, but that's not the case globally. Globally, there are countries that are growing very fast and are actually concerned about inflation. If we look at the majority of the top markets, we see that they are in emerging markets. Number one, Sri Lanka, their bull market, which started in December of 2008, they've gained 380%. Some of the other big gainers, Argentina, Peru, Indonesia, Thailand, China, India, Hungary, Philippines, Russia, Colombia, Brazil. These are all emerging markets. They all started their bull markets in late 2008 before the U.S., and they've had tremendous gains. As contrast, the U.S., the current bull market started March the 9th of 2009 and has gained somewhere around 82% from that low. So we think that emerging market trend will continue on into 2011. So the bottom line is we think that we're going to stay aligned with this global uptrend, keep an eye on our indicators and data that maybe valuations have gotten overvalued. We'll keep an eye on the sentiment, looking out for excessive optimism in the markets, and we'll keep an eye on interest rates. And when those things start to deteriorate, we'll probably reduce our equity exposure. In terms of the S&P 500, the U.S. market, give you a little bit more information on that. Number one, in the United States, we have what's called a presidential cycle, meaning that where we are in terms of a president's term has a big impact on the markets, because the markets, so much today, markets are driven with economic and fiscal policy from the government, unfortunately. And so as we look at President Obama is in year 2 of his presidential term in 2010. This latter half of the second year of a presidential term is usually very strong, as well as the first half of his third year is extremely strong for a president. In fact, January of his third year, if you happen to be interested, if you average all the presidents' year 3 January since they began keeping records, it's actually the strongest month on average of a president's term. And that strength continues on into the middle part of the year and then starts to drop off, and then year 4 of a presidential term is usually the latter half of 3, and the fourth year is usually marked by some significant weakness. One thing that we've seen on the volatility of the market, the volatility of the stock market has come down significantly from 2008, and so when things may get a little bit rough in the latter half of next year, we don't expect the volatility to spike back up to where it was in 2008. One of the reasons we think that the U.S. As well as globally that we're in for a rough patch next year is simply if we look historically at the bull market that started in March of '09, it's already been going on for about 1.8 years. If we look at since the early 1920s, we go back and we study the market performance after cyclical bottoms, the rebound and the upswing of the bear market. When we look at the average bull market has been 1.3 years. So already this particular bull market has gone on a little bit longer than average. In fact, the median bull market after recoveries has been slightly less than 1 year. And we look in terms of actual return, the rebound from the market low, the market went up about 69%, and on average, the market has gone up 41%. So what's all this mean? I know that it's hard to, when you're listening or watching, to grasp these figures. So what's all this mean? Basically, the U.S. has been in a secular bear market, meaning a multi-year since 2000 period of stagnant growth. The market isn't going anywhere. The consumer is not faring too well. We've got high unemployment. All these factors are what we call a secular bear market, or contribute to that bear market. So typically in these bear markets, you do have ups and downs. Market goes down a lot and then it goes up. And so we go back in history and we study similar time periods. And so what I'm trying to get across to you is that already that this rebound from the terrible bear market we had has gone on much longer than usual. Now the bear market was also more severe, so we'd expect the recovery to be a little bit better than normal, but it also gives us some concern. And so when we look out towards mid-next year, if the bull market continues as we think it is, then we're really going to be in for a long period of time that is much, much longer than normal. So we just want you to be cautious, and we'll be updating you on the show, of course, as we go along. So let's stop there for today. We'll cover some more of this next week and on into 2011. But just to kind of summarize, for the stock market, we see both the U.S. and globally, the market's heading higher in the first half of 2011, with emerging markets continuing their leadership. As interest rates and growth begins to moderate around the world, we would expect for interest rates to start to rise and the global market to have a decline next year. So we'll see you next week. That's all the time we have for All Things Money. I'm David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.